everyone, this is Mike Jacka from Enria and Real Estate Promo with another Flip It Friday video. And today I want to talk about running comps and determining your ARV or after repaired value, because this is a time of year that I see a lot of people make mistakes on that, where they'll because when we're looking at the comps, we want to, or comparable properties, we want to look at properties that sold in the last 30, 60, 90 days. And if we look at properties that sold 30 days ago, 60 days, 90 days ago, they sold during the peak of the season, during the hot summer market, and the real estate values have gone up, and they're now starting to go back down. And so right now we're like at that peak value. It's like in our market right here, they just peaked. The median price the month before was $290. The median price that just came out was $283. So we're in that decline value on the peak median sales prices, which when we're looking at our comps right now, that means we're going to be looking at comps that are going to be coming in at, if we look at the median, at the $290 price. But if you look at history, properties will go from by the time we get the property on the market, so we buy it, do the renovation on the property, and then go sell the property, we're going to be another 3 months out, typically 3 to 4 months if we're doing a decent full-blown, $50,000, $60,000, $70,000 renovation. That's going to take us 2-3 months on average to get those done when we get the property on the market. That means we're going to be putting on the market come December, January, right? And those are going to be at the lowest time of the year. So if we're at 290, 280 right now, we'll probably be around we'll be bottoming out around 265. Well, the difference between 265 and 290 right now, that is that's basically what the profit margin was for most investors when they were running their comps. So like, okay, well, I'm looking at maybe a $25,000 or $30,000 profit margin. Well, that just got eaten away right now because you're running the comps today and you're putting the property on the market in 6 months from now, or in 3 or 4 months from now, when the values have gone down and they've hit that low valley of the season, because it's cyclical when it comes to annual prices. In the summer months, it's always going to be the peak. So usually it's going to be around June, July is the peak height, and then usually around January, February is the peak low, and that's when the prices start coming back up again. So that's something you have to be cautious of. And the way I handle that is when I'm running my comps right now, like if I'm finding them at the 290, 280 price range, I'm going to take about 10% off, because I know by the time I get the property back on the market, it's going to be about 10% lower than that. So I need to do that now. Unless I plan on holding on to the property, then it doesn't matter. But if my game plan is to fix it and flip it and resell it for a profit, I need to take that 10% off now, because by the time I get the property on the market, 10% reduction. On the flip side though, when we're looking at the properties in January and February, then we'll be looking at properties that sold at the bottom of the market. So by the time we get them on the market, we'll have hopefully we'll have had appreciation on the properties. So maybe by then, if we're at 265, 270, and we're looking at our comps, by the time we get the property renovated, fixed, and put it back on the market, it might be worth that 280, 290, 295 price by the time we get ready to put it back on the market. So just keep that stuff in mind when you're running your comps at this time of the year. That is very important, that if you miss that one, you could be losing out on profit, or what you're going to end up having to do, and this is what most investors do, is they have to hold on to it for another 3 months or so. Well, that 3-month holding period can cost you a lot of money. So you have to factor that in, especially if you got hard money. Now you're paying higher interest rates, and a lot of times with the hard money, you might have factored it out where by the time you think we're going to get on the market, now you got to hold on to it. Now you're going to have to pay an extra point or two on top of that. So a lot of your profit margin now starts getting eaten away because of your longer holding time frames. So you need to plan for that stuff in the beginning when you're buying at this time of the year. So hopefully that makes things clear and you understand what I'm talking about there. And if you like these videos, please hit the like button. If you want to get notified right away, hit the bell, and you'll get the notifications as soon as I publish new training or new how-to videos. So with that, I will see you guys back here next week on another Flip It Friday video.